Well, for more on Apple and the rest of today's market action, let's bring in Charles Schwab, Chief Global Investment Strategist Jeffrey Kleintop, and Vital Knowledge founder Adam Crisafulli. Adam, I'm going to kick this off with you because Apple did have a down day to the tune of 4%. And we know, in general, tech and the mega cap tech names specifically had a very weak day, even as most of the sectors in the S&P finished in the green.
Yeah, and I think that's a great point. The equal weight S&P today was up about 80 basis points, which is a very strong performance. And then you saw a lot of heavy selling, and like you said, mega cap tech. Apple led on the downside. There was some negative fundamental news. There have been a few headlines out in the last couple of weeks talking about diminishing market share in China, a lot of headwinds with the iPhone in that market, negative reviews for Apple Intelligence, et cetera. But it really does seem to be more of a sector-wide, market-wide trend of investors kind of pivoting into some of the more valued cyclical groups and out of mega cap tech. Now, again, this follows huge outperformance for mega cap tech. So the year-to-date outperformance in the equal weight S&P is very, very modest compared to the last 2 years. We'll have to see if this continues. But I think it's much more a technical rotation than it is anything that's terribly negative with Apple fundamentally. Okay.
Jeff, I want to get your thoughts on the market here, especially given the fact that whether we're talking about Apple, which has been a buyback beast, or we're talking about some of the banks and financials that have kicked off this reporting season, including Citigroup today with a $20 billion buyback. You have some interesting thoughts on what 2025 brings in terms of that buyback process.
Yeah, this is usually buyback season, not just earnings season. Usually companies up their buyback programs for the year when they report their fourth quarter results, which is right about now. But Citigroup and some of the others could be outliers. We've now got a much more expensive environment for funding buybacks. Back in 2020 and 2021, the yields on U.S. BBB bonds were below 2%, and that funded a massive surge in buybacks. But now the funding cost is over 5%. Stock valuations are much higher, and the demand for capital among big mega cap players being put into AI expenditures may take precedence over buybacks. So we could see maybe a buyback recession this year, and that could erode some of the support for some of those highly valued stocks, for example, like Apple.
Adam, I wonder what you make of the signal that we're getting on the consumer right now. Target's report kind of signaled that discounting was an issue because overall sales were good, but profits weren't. And that reminded me of what we heard from the kind of Signet jeweler as well, that people were kind of looking for bargains. Richemont, different, smaller luxury segment, but the overall consumer that the likes of Signet and Target are appealing to, while they're buying, they seem to be buying carefully. Any new insight out of that?
Well, I thought the news this week.
Sorry, that's for Adam Crisafulli.
Sorry.
Yeah, I would say the news this week on the consumer, on an absolute basis, was encouraging. You had more upside pre-announcements than downside ones out of ICR, with a lot of companies saying the holiday season ran a bit ahead of expectations. Like you mentioned today, Richemont was very encouraging for luxury, which has been very beleaguered. And then the banks, which have probably better insight into the consumer overall than anyone else, also that consumers' resilience are still spending, et cetera. Definitely still at the lower end of the consumer's income spectrum. They're still struggling, and they're being a little bit more judicious in how they're spending. But I think in aggregate, the news this week for the consumer, I thought was pretty encouraging and healthy.